creating wealth, freedom, and security using real estate investing. This is Get Real Wealthy. I've been getting a lot of questions around commercial financing versus residential financing, and I wanted to highlight some of the differences because it's really important to understand that there are big differences when it comes to residential financing versus commercial financing. So first of all, you want to get a big idea of the difference. Residential financing is usually 1 to 4 unit properties. Commercial financing is usually 5 or more properties. Also could be industrial properties, retail properties. That's usually storage units. Those are usually commercial properties. So the financing process is different depending on what type of financing you're doing. So for example, for apartment buildings, you may only get 75% loan to value. You may only get 70% loan to value if you're doing conventional financing. That means that you have a higher down payment if you're using conventional financing on apartment buildings. If you're doing a single family home or a rental property, it's very possible that you can have a higher loan to value. Okay, so that is something that is quite different between commercial financing and residential financing. Now, there is the opportunity with commercial financing to get a higher loan to value. That's if you use Cmhc financing on commercial properties, and you can go to 80%, 85% loan to value, even higher sometimes. In commercial financing, when you're in conventional, you're usually doing 25-year amortizations. But if you are in commercial financing with Cmhc, you can do 30-year or 35-year, sometimes even 40-year amortizations. So that will really lower your monthly cost, okay? And if you are in an apartment building with Cmhc financing, again, you could have a higher loan to value, 80%, 85% loan to value. So that's something to keep in mind when you're thinking about your debt servicing and your loan to value when you're looking at apartment buildings. When you're looking at residential properties, typically it's based on your debt coverage ratio. Okay, and so that means how much your property can debt service. The income from the property needs to be at, let's say, at least a 1.1 debt coverage ratio. And that's how those residential properties will, you'll be able to get financed for it. So that means that sometimes if they are looking at your income and who you are, and they look at the property themselves, especially if you have more than one property, you may get a lower mortgage amount than what you thought. Now, it is possible with residential properties to still get 80% loan to value, even though you have a debt coverage ratio that's lower than 1. It doesn't happen very often, and banks don't like to lend a lot of properties like that. So usually instead they'll just give you a lower mortgage amount, but it is possible in the residential space. In the commercial space, usually if you're looking at a lender, if a conventional lender like one of the big banks, they will probably end up giving you like a 1.1 or 1.2 debt coverage ratio. That means that the amount of income that you have versus the amount of debt that you have is about 10 or 20% more than what your expenses are. And how they calculate expenses will be different depending on the institution. But it gives you a good idea of what that looks like. Now, if you are getting Cmhc funding on a commercial property, this is an apartment building again, you're going to end up with usually if you're going to try to close on a Cmhc mortgage, it's going to take 4 or 5 months to get that. And that usually isn't conducive to closing on an apartment building. So usually you have to use some sort of bridge mortgage that gets you from the purchase to when Cmhc financing is ready. So it can be a little bit of a challenge. Okay, let's keep going. So when you're looking at commercial buildings, you're usually looking at cap rate. And cap rate is Basically, the cap rate is made up of interest rate, the location of the property, and the type of asset that it is, the quality of the asset. Those are the three main components of what a cap rate is. And so that can change. When you're looking at residential properties, it is usually based on what other properties have sold in the area. It's based on a comparative method. So if the property next door sold for $800,000, it's most likely that your property is going to sell for $800,000. It's not based on the net operating income of the property. Okay, so it can be very different. So financing is different because of that. When you're looking at the paperwork involved in commercial financing, it can be a ton of paperwork. Actually, I prepare everything in digital format ahead of time, every time I'm going through a financing process, because I need everything ready to go. They ask for hundreds of documents. So it can be very tedious, and it's something that you really have to prepare for ahead of time. Now, residential financing, they do ask for a lot of documents depending on the type and size of your portfolio, but I feel that it is a lot less than what you would get from a commercial financing package. Other things that are different about commercial versus residential financing. Commercial financing, there are broker fees. Usually, if you're going through a broker, you're going to pay them a fee, and you're going to pay them a fee whether they close on the property or not for you. And that can get kind of expensive. And broker fees can be like $500 or $1,000. We're talking like tens of thousands of dollars sometimes, depending on the size of the building that you're working on. There can be some broker fees when you're dealing with mortgage brokers, but oftentimes if you're going to banks, you're not dealing with broker fees unless, sometimes there aren't broker fees on residential properties because even though you're working with a mortgage broker, because the bank is covering those fees. So it's something that you don't have to worry about. So you should always investigate that when you're talking to a mortgage professional around how they're getting paid, whether it's commercial or it's residential. When you're dealing with financing for commercial property, often they're going to be asking for a phase 1, a phase 2, and hopefully you never get to a phase 3. But phase 1 is usually a historical understanding of the environmental contamination of a particular building. They are not going to want to give you financing, or it's going to be harder to do that. Sometimes you'd have to go, if you're worried about having a dirty phase 1, you might actually go to a credit union who may ask for more down payment and more fees that are associated with it, but they may not ask for a phase 1 as a component of their due diligence process. There are different ways that over time that you learn that work and don't work. But if you're going to go to one of the main lenders, a big bank, or you're going to go through one of the bigger institutions that do financing across Canada for apartment buildings, you're probably going to need to have a phase 1 done. And if you have a dirty phase 1, that means you have to do some sort of remediation, and that can cost tens of thousands of dollars. And then once you get a phase 2 done and it comes back clean, then you're able to get your financing in place. Lastly, when you're dealing with a residential property, it's unlikely that you're ever going to have to do a phase 1 or a phase 2. In a residential property, you maybe have an inspection. In a commercial property or 5 or more unit property, you'll have a building condition report. A building condition report could cost you $3,500. An inspection could cost $300 to $500. So it's very different. Appraisals, typically you're going to have to pay for an appraisal with an apartment building depending on the size of it, and that appraisal could cost you $3,500. If you have an appraisal in residential properties, it's usually paid for by the bank or broker. Sometimes you would pay, but it would be in the order of $300 to $500. And when you're dealing with commercial and residential, you can take on a CMHC fee. CMHC fees in commercial can really be expensive, but again, it reduces your overall cost for your monthly cost on your mortgage, so they do offset themselves. So if you're paying CMHC fees, Usually there's an application fee. It can be like, I believe it's $100 per unit, depending on the size of the building that you're applying for. You're giving that ahead of time. And if the CMHC doesn't approve your application, you can get back like 50% of it. It can be quite expensive. So, there's some pros and cons to CMHC financing, but that's part of the process. And plus you have the additional costs that come with CMHC financing. When you're looking at residential properties, if you are doing a lower down payment because it's your first property, not necessarily an investment property, but it could be if you're living in one of the units and it's a multi-unit property, you would be able to get a lower down payment and you would be paying that insurance or CMHC fee in order to do that. Well, we covered a lot of information today regarding commercial financing and comparing that to residential financing. You saw some of the similarities and differences. Hopefully I gave you some interesting insights. And if you enjoyed this episode, please like, subscribe, and give us a review. Share this with other people, and we'll see you on the next episode of Get Real Wealthy.
Make sure to check out getrealwealthy.com.
Until next time, I'm Quentin D'Souza. Get out there and take action.
The views and opinions expressed in this podcast are provided for information purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to getrealwealthy.com.